Hey guys, welcome back again to our Deep Dive podcast. Today we're diving into Carvana, the online used car retailer. You've probably seen their car vending machines popping up everywhere,
Oh, yeah, for sure.
but behind that flashy image, things are getting a little chaotic.
Yeah, a little bit.
Would you say that's an understatement?
Definitely. It's a classic case of a company trying to disrupt a huge industry, like
Yeah.
used car sales.
Right.
And as you often see, they're running into some major roadblocks along the way.
Yeah, exactly. And the roadblocks in this case are pretty traumatic.
For sure.
We're talking a near bankruptcy experience in 2022, followed by a massive stock surge of 284% in 2024.
Wow.
You'd think that's the comeback story of the century. But then things take a turn
Uh,
with a scathing report from Hindenburg Research accusing Carvana of some shady financial practices.
yeah, that Hindenburg report is a big deal because they have a reputation for uncovering corporate fraud. When they release something like this, investors pay attention.
Yeah.
And that's what we're seeing with Carvana's stock taking a hit.
So we've got this dramatic financial roller coaster ride happening.
Definitely.
And then you throw in this bombshell report. Plus, we've got news articles about law firms investigating Carvana for potential securities violations.
Yeah, wow.
It's a lot to unpack. So where do we even begin?
Well, let's start by understanding Carvana's business model. They're basically trying to make buying a used car as easy as ordering something online.
Huh.
Skip the dealership, haggling, browse a huge inventory online.
Okay.
Get 360-degree views of the cars and have it delivered right to your door.
Right. The whole convenience factor is a big part of their appeal.
Definitely.
But wouldn't you say that kind of rapid growth often comes with growing pains?
Yeah.
Especially when you're trying to shake up a whole industry.
Absolutely. And we see those growing pains reflected in Carvana's wild stock fluctuations. Remember that near bankruptcy in 2022?
Yeah.
Their stock was practically in the basement. Then, just a couple years later, it's soaring high, only to be knocked down again by this Hindenburg report. That kind of volatility should raise a red flag for any investor.
Okay, so red flag number one, wild stock swings. What's the next warning sign we should be paying attention to?
Well, the Hindenburg report alleges that Carvana might be misleading investors about its financial health by secretly selling off loans to a related party disguised as an unrelated third party. They claim that Carvana has been quietly funneling these loans to a trust affiliated with Cerberus Capital Management, where Carvana director Dan Quayle holds a senior position. Now, this is where things get really interesting for you as a potential investor.
Called on Dan Quayle like the former vice president.
One and only. But even more importantly, these types of related party transactions can be a huge red flag. Public companies have a legal and ethical obligation to be transparent with investors about these kinds of dealings. If they're not upfront about it, it could mean they're trying to hide something or manipulate their financial performance to look better than it actually is.
So for someone who's not a financial expert, break down why this is such a big deal. Why should we care about these so-called related party transactions?
Think of it this way. Imagine you're buying a used car from a friend, and they tell you it's in perfect condition. But they don't mention that their brother, who's a mechanic, just patched up a bunch of problems without telling you. Would you feel comfortable buying that car?
Probably not.
Probably not, right? Because there's a lack of transparency and you don't know if you're getting the full picture.
Okay, I see your point. It's about trust and whether the company is being upfront with its investors.
Exactly. And when a company like Carvana is potentially hiding these related party transactions, it raises serious questions about their transparency and whether they're playing by the rules. This type of behavior can erode investor confidence and ultimately hurt the company's long-term prospects.
All right, so I've got the wild stock swings, the allegations of hidden dealings. What else should we be looking at to assess Carvana's situation?
Well, let's dive into some of the specific numbers from the sources you shared. In 2023, Carvana generated $10.77 billion in revenue. Not a bad figure, but it's important to note that this is actually down about 20% from the previous year.
Wait, a 20% drop in revenue? That sounds like a pretty significant decline for a company that's supposed to be a growth story.
Right.
Wouldn't that make you question the sustainability of their business model?
It definitely raises concerns. Remember, rapid growth followed by a sudden slowdown can sometimes signal underlying problems. We need to consider whether this revenue drop is just a temporary blip or a sign of deeper issues.
So what else do we need to consider?
Well, their net income for the past 12 months was $17 million. Now, on the surface, that might seem positive. They're making a profit, right?
Yeah.
But remember, this profit represents a very thin margin. Any unexpected expenses or changes in the used car market could easily wipe that out.
Okay, so their profitability is a bit shaky, especially with those potential legal troubles looming. What about their stock price?
Right now, their stock is trading around $232.32. Analysts are still projecting decent revenue growth for 2025, around 17%. The average price target among analysts is $242.59, and the overall consensus is still a buy.
So on paper, it might not look terrible, but given everything we've discussed, those rosy projections might be a bit misleading, wouldn't you say?
That's the key question. We can't just look at these numbers in isolation. We have to consider the context of their volatile history, these new allegations, and the potential impact of the legal investigations. All of these factors add a layer of uncertainty that makes it difficult to assess Carvana's true financial health. And for you as a potential investor, that uncertainty translates into risk.
So it's not just about the numbers themselves. It's about understanding the bigger picture and how all of these pieces fit together.
Precisely. And that's why it's so crucial to dig deeper and not just rely on surface level analysis or flashy headlines. You have to look under the hood, kick the tires, and really understand what's going on before making any investment decisions.
All right, so far we've uncovered some pretty serious red flags: extreme stock volatility, questionable related party transactions, a concerning drop in revenue, and fragile profitability. Plus, there are those ongoing legal investigations to worry about. Where do we go from here?
Well, next, we should dig a little deeper into those legal investigations and what they could mean for Carvana and its investors. We also need to examine another crucial aspect of their financial health, their debt levels, which could be a major factor in their ability to weather this storm.
Sounds like we've got even more to uncover. Let's take a quick break and we'll be right back to dive deeper into the Carvana saga.
Sounds good.
Okay, so before the break, we were talking about those law firms circling Carvana like sharks smelling blood in the water. What exactly are they investigating, and what kind of trouble could Carvana be facing?
Essentially, these law firms are looking into whether Carvana violated securities laws by misleading investors about their financial dealings, specifically those related party transactions we discussed. If they find evidence of wrongdoing, Carvana could face some serious consequences.
Like what kind of consequences? Spell it out for our listeners.
We're talking hefty fines penalties, and in some cases, even criminal charges for executives involved. Not to mention the potential damage to Carvana's reputation and investor confidence. It's a legal and financial minefield they're trying to navigate.
And we can't forget about the potential impact on investors.
Yeah.
If these allegations turn out to be true, you could see the stock price plummet even further, and you could even lose a significant portion of your investment.
Right. That's why it's so crucial to understand the risks involved before jumping into any investment, especially one as volatile as Carvana.
Now, going back to the Hindenburg report, they specifically called out this purchase commitment agreement Carvana had with Ally Financial. Can you explain what that is and why it was so significant in this whole mess?
Sure. Imagine you're running a lemonade stand and you need a steady supply of lemons. You make a deal with a lemon grower where they agree to sell you a certain amount of lemons each week at a set price. That's essentially what a purchase commitment agreement is. One party agrees to buy a certain amount of goods or services from another party over a specific period.
So in Carvana's case, they had this agreement with Ally Financial, a major auto lender, where Ally was buying up a big chunk of the loans Carvana was making to customers buying cars. That's like Ally was guaranteeing a market for those loans.
Exactly. And that was a big deal for Carvana because it gave them a reliable source of cash flow and allowed them to grow rapidly. But according to Hindenburg, Ally started scaling back their purchases, putting a strain on Carvana's liquidity. That's when this mysterious, unrelated third party swoops in to buy those loans, which Hindenburg claims is actually that related party connected to Cerberus Capital and Dan Quayle.
Okay, so this is where things get really murky.
Yeah.
If Carvana was intentionally misleading investors about the true nature of these loan sales and propping up their financial performance, it seems like that would be a pretty clear violation of those securities laws you mentioned.
That's the argument Hindenburg is making, and if the law firms investigating find evidence to support it, Carvana could be in a world of hurt.
Now, before we completely write off Carvana, let's take a devil's advocate approach for a second. Their revenue, while down, is still significant at over $10 billion. And they are technically profitable, even if it's a razor-thin margin. Couldn't you argue that those factors combined with the projected growth indicate that maybe Carvana isn't as doomed as some people think?
It's a fair point. There's always more to the story than what initially meets the eye. However, we need to remember that Carvana has a history of burning through cash. Remember that near bankruptcy situation in 2022? They had to raise billions of dollars in debt and equity just to stay afloat. And that brings us to another crucial piece of this puzzle, their debt levels.
So even if they're technically profitable, they still have this mountain of debt hanging over them, right?
Absolutely. High debt can be a major drag on any company's profitability and growth prospects. Think of it like trying to run a marathon with a heavy backpack on. even if you're in good shape, that extra weight will slow you down and make it harder to reach the finish line.
So how does all of this affect their stock price? We mentioned that analysts still have a buy rating on Carvana and a price target suggesting potential upside. Shouldn't we be factoring that into our assessment?
Analyst ratings can be helpful, but it's important to remember that they're just opinions based on certain assumptions, and those assumptions can change quickly, especially when you're dealing with a company like Carvana that's facing so much uncertainty.
So those buy ratings could quickly turn into sell ratings if Carvana can't address these concerns about their financials and the legal investigations. It seems like a lot is riding on their ability to prove that their business model is sound and that they're operating ethically.
Exactly. It all comes back to trust. Investors need to feel confident that the companies they're investing in are being upfront and honest about their operations and financials. Right now, Carvana has a lot of work to do to rebuild that trust.
All right, so we've covered a lot of ground here, from Carvana's innovative business model to their wild financial swings, those concerning allegations, and the potential legal fallout. What are some key takeaways for our listeners who might be considering investing in Carvana or other companies with similar explosive growth stories?
First and foremost, do your homework. Don't just get swept up in the hype or rely on flashy headlines. Dig into the company's financials, understand their business model, and carefully assess the risks involved.
It sounds like you're saying don't just buy the car because it looks cool in the vending machine. Pop the hood, take it for a test drive, and make sure it's mechanically sound before you sign on the dotted line.
Exactly. And remember, there's no such thing as a risk-free investment. Every investment comes with its own set of risks, and it's crucial to understand those risks before putting your hard-earned money on the line.
So to sum it up, Carvana's future hinges on whether they can address these allegations, regain investor trust, and prove that their business model is sustainable. It's a high-stakes game they're playing, and it will be interesting to see how it all unfolds.
Indeed. This is a story that could go in many different directions, and we'll be keeping a close eye on it. But for now, let's shift gears and talk about what this situation tells us about the broader landscape of investing in disruptive industries.
Sounds like a good segue.
Ah,
Let's explore the bigger picture. All right, so we've been dissecting this Carvana situation, all the twists and turns it's taken.
yeah, it really has. It's a wild ride for sure, and a perfect example of how quickly things can change in the world of disruptive businesses.
Exactly. 1 minute, they're the darlings of the tech world, disrupting the old-school car dealership model.
Uh-huh.
And the next minute, they're facing serious allegations and fighting to stay afloat.
Yeah, it's tough out there.
It's a cautionary tale that highlights the importance of looking beyond the hype and really understanding the fundamentals of a business before you invest.
That's such a crucial point. Investors often get caught up in the excitement of a new technology or a disruptive business model, and they forget to ask the tough questions.
Right? Like, is this company actually making money? How much debt are they carrying? Are they being transparent with their investors?
Exactly. Those are the questions that can make or break your investment, and the Carvana story is a perfect illustration of that.
It's like that old saying, if it sounds too good to be true, it probably is.
Yeah, exactly. So, what can our listeners take away from this whole Carvana saga? What are the lessons we can apply to other potentially risky investments?
I think the biggest takeaway is the importance of due diligence. Don't just take those analyst ratings at face value or get swept up in the hype. Do your own research. Dig into the company's financials and understand the risks involved.
I couldn't agree more. Look for red flags like extreme stock volatility, questionable accounting practices, high debt levels, and any signs that the company might not be acting in the best interests of its shareholders.
And don't be afraid to walk away from an investment if something doesn't feel right or if the risks outweigh the potential rewards. There are plenty of other opportunities out there, and it's better to be safe than sorry.
Absolutely. It's your hard-earned money, and you need to protect it. So do your research, trust your gut, and don't be afraid to say no to an investment that doesn't meet your standards.
So to bring it back to Carvana, is this a brilliant turnaround story or a house of cards about to collapse?
Unfortunately, we don't have a crystal ball. A lot will depend on how they handle these current allegations, whether they can regain investor trust, and ultimately prove that their business model is sustainable in the long run.
It's a high-stakes game they're playing, and only time will tell what the final outcome will be. But for now, I think we've given our listeners a lot to think about and some valuable tools to apply to their own investment decisions.
Absolutely. We've explored the company's history, their business model, their financial performance, and those serious allegations they're facing.
We've highlighted both the potential and the risks associated with investing in Carvana. Ultimately, the decision of whether or not to invest is up to each individual listener.
But one thing is certain, Carvana's story is far from over. and it will be fascinating to see what the future holds for this company.
Indeed. This is a story that could go in many different directions, and we'll be keeping a close eye on it.
We'll be sure to keep you updated on any major developments right here on the Deep Dive.
That's all from us, and thanks for tuning in. Stay tuned for more Deep Dive. And remember to like and subscribe.